This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Hello, this is Llanes with WealthNet Investments, and this is the Market Call of the Week. And we're going to be talking a lot about the markets in terms of long-term perspectives. And one of the things I want to talk about to begin with is that the market broke out, the S&P 500, it broke out here in the fall as we're coming into the fall. This is a very bullish sign for several reasons. The first thing is that typically the fall is seasonally a volatile time. Historically, there's a lot of times when the markets are selling off. And usually the higher volatility happens in August, September, sometimes October. And the other thing is we're coming into an election, which is considerably uncertain. A lot of people feel that the Democrats want to unwind Trump's initiatives and that they have an opportunity potentially to gain some traction in the November 6th midterm elections. First of all, a midterm election is really important to understand what it is. I know some people sometimes get confused what it is, but simply it's just an election where people can elect their representatives in the middle of the term of the president. So they're staggered against the presidential elections. So right now, the U.S. Senate has 51 Republicans and 49 Democrats, including 2 independents. The 2018 Senate election takes place on November 6th again, and there are 35 seats up in 2018, of which 26 are held by Democrats. So there seems to be an opportunity in many people's mind that the Democrats can gain some control in Congress. However, considering what the economy is doing right now, it's very strong. I think the default way of thinking is that this is not going to happen, but it's going to be very close. The default way of thinking is because we have a strong economy, most of the incumbents will probably be coming back to office. So what I do expect, however, is more volatility to come in November because despite all of the stuff that's going on, there's going to be a lot of debate over the progress of Trump's term so far. Democrats will say Obama started all the great economic numbers. Employment growth was really due to Obama. And they'll say that crime is up and the number of people who have health insurance is down, et cetera, et cetera. And then you're going to see the Republicans coming out saying, hey, look, the stock market is at highs, unemployment is down, less people are on food stamps, recent GDP growth is strong, above 4%, we're getting better trade deals, and the list goes on both sides. So that's going to really, that debate will probably bring in some volatility, I would expect. So that's something that we need to look at. So we did have strong corporate earnings come out. We had U.S. corporate profits booming in the second quarter, up 16.1%, according to the Commerce Department. Because of lower corporate tax rates that we saw that was signed into law last year, taxes paid by U.S. companies in the quarter were down 33% from a year earlier, so that was significant. The U.S. economy grew at 4.2% in the second quarter, which is much higher than the average growth in the prior administration had been seeing. So that will be some of the arguments you'll see. Unemployment is low, home prices are higher. Now, with all that said, we want to just point out that there's likely to be more volatility if the debate gets spirited or if some unusual thing happens. But as of right now, that breakout in the S&P 500 into the fall and into the uncertainty of everything that we're seeing seems to be a bullish sign through the end of the year. So we'll take a look at that as time progresses. Okay, now I want to switch to talk about the leadership in the market. 2 sectors that are leading the market right now in this breakout are the technology sectors and the consumer discretionary sectors. Now, even though we've had a lot of leadership in these 2 sectors recently, I want to pull back and go and look at a long-term perspective to make a point. Let's first start off with the technology sector. What this chart shows is the technology sector going all the way back to the dot-com bubble that happened in March of 2000. So if you see here on the left-hand side of the chart, the technology sector topped out in March of 2000. It was around 653 on the index. Now the chart below the price chart up top is the relative strength chart. So that shows the relative performance of the technology sector compared to the S&P 500. You see that we had a major top in relative performance on March 2000. And since that time, believe it or not, the technology sector has yet to surpass the high in relative performance compared to the S&P 500, the general stock market, since the dot-com bubble. A lot of people forget this. Having a sector focus can be very dangerous. if you were really focused on technology over this time, although you've had recent performance, it's really important to note that that bubble is yet to be surpassed. Now, some would argue that that means that we're going to have better performance in the technology even further and longer. So let's switch over to the next chart and compare the technology sector long term versus the consumer discretionary sector. The consumer discretionary sector has to do with retailers and really those industries that are affected by consumer spending that are not staples, not the things you have to buy, but things that you want to buy. So when you're feeling more flush, you spend more money in the consumer discretionary sector. Now, if you look at this chart, it's going in the same time frame. If you look at this chart, looking at the same time frame from the dot-com high, you can see on the left there, the dot-com high on March of 2000, the consumer discretionary sector dramatically outperformed technology. Look at the relative strength chart on the bottom. It's actually near the highs, well above the trend line, the center trend line of the regression. Consumer discretionary stocks really have far outperformed technology since the dot-com bubble. So the moral of this story is that it's important to have diversification. It's important to have a strong portfolio process. And, we can sometimes get lost in the short-term details and not see what's happening in the long term. Okay, now what I want to do now is switch over to the emerging markets. If we take a look at this emerging market charts, we see a very interesting development. If you look at the long term, going back to October of 2007, we saw a peak in the emerging markets ETF, that's what we're looking at here, on October 1st, 2007. And we had a big dramatic drop after that into November of 2008. And since that time, we've been in a congestion zone, a massive multi-year congestion zone. And we hit a high on May of 2011 that was a significant high at around the $50 range. Now, what you see there is we've recently, since the low in January 2016, we started rallying and we've been in an uptrend. And we are now, if you look at this month's action, these are monthly bars, each one of these bars is a month, you see that we're at the low end of that trend line and we've been getting significant support. There's been bullish monthly market action as the emerging market stocks bounce off the monthly lows at the lower end of the trend line. We have what technicians call a hammer pattern, where the market sells off dramatically and then rallies off the lows. We saw that happening into the congestion zone. So that is a bullish sign. And we have been seeing that the emerging markets have been underperforming, but now we're seeing potentially that we could have some stabilization. Now, one of the things I want to point out is that the emerging market valuation and growth measures seem more attractive than the leadership in the United States. So I want to switch over to this next chart that shows the differences in the valuation and growth metrics. So if you look at the valuation and growth metrics here, these columns show the comparison of the price to earnings, price to book, price to sales, and price to cash flow, dividend yields, and long-term earnings growth. And it really shows the difference between emerging markets on the left column, technology in the middle column, and consumer discretionary on the right column. And what you see is the emerging markets right now are trading at 11.12 times prospective earnings. So that's future expected earnings. Technology, on the other hand, is trading much more expensive in the United States at 18.56 times earnings, and consumer discretionary at a whopping 22.93 times earnings. And you can go down the valuation metrics and you have the same story. Price to book, emerging markets trading at 1.5 times, technology is trading at almost 5 times book, and consumer discretionary, similar, 4.4 times book. You look at the same thing with price to sales, emerging markets trading at 1.25 times sales, technology is trading at 4 times sales. Consumer discretionary trading at 1.84 times sales, which is not quite as dramatic there. Same thing with price to cash flow and dividend yield. Emerging markets has a dividend yield of 2.95, whereas in the technology 1.49, 1.24. And if you look at the long-term earnings growth, the emerging markets have been growing at a faster pace, 17.59% long-term earnings growth versus technology of 10, consumer discretionary of 14. So the point of this is that sometimes we get into these modes where the market is on a trend and it's important that you stay on that trend, but the valuations are giving us a warning sign and we want to be careful with the current leadership. Even though we're in a bullish mode, there are signs that we need to be careful. Okay, so just to summarize, the markets look bullish technically, but there's complacency out there and it's dangerous to have complacency, so we want to be careful. Stocks are doing better than normally in the fall. The expected volatility for the elections because of debates are likely to start coming to light. And the default view at this time is that the Republicans will probably keep control because of the economy, and any changes that happen from that would be a disruption. So we want to keep an eye out on the developments of the election. Leadership is still the technology and the consumer discretionary, but valuation is signaling a warning sign. Emerging markets are stabilizing and could offer long-term growth potential for long-term investors because of the valuation and long-term growth prospect gap between the US and international, in particular emerging markets. So the idea is to trim and trail your winners. Trim and trail means that as you make more money, take a little bit off the table, and to trail up your stops. You don't want to give a lot back in this type of environment. And so you want to trim and trail your winners, and then you want to initiate new positions in longer term attractive investments. That's kind of our approach and our analysis at this time. Okay, this is Louis Llanes with WealthNet Investments for the Market Call. Hope you guys have a great weekend as we're coming into Labor Day weekend, and happy trading.
If you like this information, be sure to subscribe and follow us on Twitter and Facebook. The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals.